first export webinar of 2017. I'm Maureen Krause, Chief Economic Development Officer at the Indy Chamber. We developed these Export Bootcamp webinar series as a resource for businesses like yours to help navigate the export waters and to help answer some of the initial questions you might have when starting to think about doing business internationally. This is all part of the Indy Chamber's suite of services dedicated to helping businesses grow. More information on our free one-on-one business coaching, webinars, Global Indy events, and other resources can be found by visiting indychamber.com/globalindy. Today's webinar will arm you with key takeaways to be proactive in setting up your business for success when it comes to tax implications as an exporter. In a moment, we'll start the webinar, but first we do have a few housekeeping details. If you're experiencing any technical difficulties, please email communications@indychamber.com at any time. We invite you to type in questions in the chat window at the bottom of your screen. Tom will do his best to answer the questions as they go, but we also have allowed time at the end of the webinar for Q&A. Type questions which are not answered during the webinar due to time constraints will receive personal answers via email after the webinar, and a log of questions and answers will be posted along with the webinar video at indychamber.com/globalindy. Now to get us started, I'd like to introduce you to Tom Miller. Tom has more than 30 years of corporate tax experience. He is a member of BKD's International Tax Services Division here in Indianapolis, serving international clients that include publicly and privately held U.S.-based multinational corporations and foreign corporations conducting business in the United States. Tom focuses on corporate tax matters, including cross-border transactions, treaty analysis, inbound structuring and planning, foreign tax credit planning, Subpart F analysis, and export incentives. He is incredibly well-suited for our webinar today. So without further ado, Tom, thank you for being with us, and I'll turn it over to you.
Thank you, Maureen. Yeah, I was very excited when the Indy Chamber asked me to talk today about tax implications for exporters. As my bio there explained or provided, I work primarily with companies doing business internationally, both U.S. companies doing business outside the U.S. and foreign companies doing business in the U.S. So I was very excited to put on a webinar here that talks about some of the basics for companies when they're starting to think about doing business internationally. And as you'll see here, there's an awful lot of people that think when they're exporting that there's all sorts of problems, particularly tax problems. And what I want to make sure everybody understands is that the tax problems really are not particularly significant. There's many more issues that you're going to deal with when you're looking to do business internationally that are more complicated. Yes, the taxes are complicated. I don't mean to make them sound like they're overly simplistic or certainly cannot be ignored, but there are solutions. Companies do this every day. And for the last 20 years, since I've been working in the international arena, it's amazing to me just how much smaller the world is now. So I'm excited to be working with the Indy Chamber here to be talking about exporting, how to make it a little bit easier, and to explain it to the group here about how some of the taxes not only are not all that daunting, but perhaps there's even an export advantage or benefit that's available to you. We'll talk about that. I do need to provide my disclaimer here, and I just want to make sure that everybody understands that this is informational. I'm not providing tax advice to you, so you can't run out and rely on everything that I say and implement without talking to your tax advisor. These issues are complicated, and so you need to make sure you get some good advice. But as I said, they're all solvable. I mean, the tax issues that are presented when you're exporting are quite solvable. So the agenda, what I put together here is just to talk about some of the basic issues that first-time exporters would deal with. What are some of the U.S. income tax effects when you're looking at exporting for the first time? What are the foreign income tax effects? Because that's the one that is very scary to people. And I'll walk through what some of those issues are, and there are potential missteps there. Provided you've got good advice and follow the rules, I think you'll be fine. There's also some VAT implications. The VAT stands for value-added taxes. I'm not a VAT expert, but certainly with what I do, I deal with VAT on a regular basis through my Praxity Alliance. So I have some working knowledge of it, and I want to assure you, as we go through that slide, that VAT should not be an impediment to exporting. Then after we go through those, we'll talk about maybe a little bit more complicated structures, what I call issues for the next step, and that's where you conduct business in a foreign country. For the basics, I'll walk you through that, and we'll talk about companies that don't have a taxable presence in the foreign jurisdiction and exactly how you do that. And then in the second part, we'll talk about what to do if you do go so far as to create a taxable presence. And then we'll finish talking about the tax incentive that's available. This is an often overlooked tax incentive, and it really, for U.S. exporters, it can save you an awful lot of money. So let's start here by talking about sales by U.S. businesses to foreign customers. My slide there looks a little bit complicated, I know, but I wanted to demonstrate here what they look like when you diagram the transactions. In this case, you've got both a U.S. individual and a U.S. corporation selling goods to a foreign customer, and then the foreign customer paying for those goods. Presumably, the U.S. either individual or corporation is obviously in the U.S. or a U.S. person, and the customer is outside the U.S. And one of the things that's important to stress here is that under our tax system in the U.S., U.S. individuals, U.S. corporations are taxable on their worldwide income. So in this type of an arrangement where the U.S. individual or some flow-through entity or the U.S. corporation is conducting that sale to the foreign person, your profit on that sale is taxable in the U.S. Not only is domestic income, but the foreign income is taxable in the U.S. But if you were to incur some taxes in that foreign jurisdiction, in that foreign country, you are able to claim a foreign tax credit for the foreign income taxes paid. We'll get into that a little bit later, but that is the mechanism that the U.S. uses in order to alleviate taxes, since they provide that all your income is taxable in the U.S. The tax credit then eliminates double taxation. Now, just as an aside, that's a little bit different than some countries do. You may hear or see in the media, and it's been bandied about in Washington as well, that the U.S. should go away from that concept and just tax domestic income. That's not where we are right now. We have a situation or a tax system that taxes worldwide income, but then provides a credit if you are taxable in the foreign jurisdictions. So let's talk for a minute about being, when you conduct business with a foreign customer. You're going to have to determine whether or not you're subject to foreign income taxes. Generally speaking, if you're just selling from the U.S. to a foreign country, you're typically not going to be taxable in that foreign country. But it may be important to point out, or to talk for a few minutes here, about tax treaties. Which country are you selling to, and how did that sale arise? Is it a country with which we have a tax treaty? If so, that's a good thing. And the tax treaties offer protection from taxation to qualifying residents. So typically in my diagram before, a U.S. individual or a U.S. individual working through a partnership or other flow-through entity or a U.S. corporation, they're all going to be residents of the U.S. and they would be able to claim treaty benefits. And so unless they're conducting business outside the U.S. in a foreign country through a permanent establishment, you're not going to be taxable on that transaction. Now, if you are selling to a country where we don't have a tax treaty, then the threshold is a little bit lower, or quite a bit lower actually. Then you may be subject to income tax if you are conducting business in that country, and not necessarily through a permanent establishment. What does that mean? I mean, that's tax jargon, and I don't mean to make this too complicated for this group. I'm trying to keep it very basic. So let me put it another way. If you are traveling to a foreign country and negotiating and executing sales, and if we don't have a treaty with that country, it's possible that country could claim that you are taxable in that country. Now, typically, if you're doing it with a treaty country, you won't have a problem. But there is a watch out there. Treaty countries, just so you understand, the U.S. has treaties with almost every major industrialized nation. The biggest one that I run across that's a bit of a surprise there is Brazil. We do not have a treaty with Brazil, and there's a lot of trade between the U.S. and Brazil. We just can't seem to get together. Their version of income taxation and ours just don't mesh. Hong Kong's another one that I see quite frequently. We do not have a treaty with Hong Kong or Singapore, both countries where we have a lot of activity, or U.S. companies do a lot of business. And most of South America, surprisingly, I mentioned Brazil again there, but I emphasized it above just because it's such a large economy. We actually, Brazil, we do not have a treaty. I messed up on that slide. I can't believe I did that. We do have a treaty with Venezuela. We do not have a treaty with Brazil. The Obama administration negotiated one with Chile that's still in process and has been hung up in some of the politics in Washington. But most of Latin America, South America and Latin America, we do not have treaties. And the same for Africa. We don't have a lot of treaties with Africa. Some of the more developed countries, South Africa, Egypt, Tunisia, and Morocco, I think are the only ones where we have treaties in Africa. So if you're going to be doing business in a foreign jurisdiction, I think it's good to understand whether or not you have a tax treaty, because that's going to dictate what you can do in that country. So let me talk for just a minute here about a permanent establishment so you understand what I mean. Typically, a tax treaty provides that a PE is a place of management, a branch, an office, etc. And you can think about it from the perspective of the word permanent. Do you have something that is there in the country that is fixed? So where if you set up an office and you're going to be selling through that office, that's probably going to create a permanent establishment for you. By the same token, if you use a foreign person to do your selling, an independent person, that typically does not create a PE for you. Let me move on. Treaties also talk about what is not a PE. And so some of the things that you can do, and this first one here is really the one that I want to point out. You can have a fixed place of business, but if it's just used to store your goods, that doesn't create a PE. Some of the other ones listed here have other reasons for them. The purchasing of goods. So if you're looking to supply some of your business and have an office, that doesn't create a PE. But we're talking about selling. So if you've got an office that does maybe advertising, again, that doesn't necessarily do it either. So there's some limited activity that you can do even through a permanent type of situation and not create a taxable situation for yourself. There are some watch-outs, and treaty abuse is a big deal in my business, in the international tax business. There are people that will examine the treaties and then try to structure their affairs in a manner that avoids creating a taxable presence, even though the government might look at that and say, what you're really doing here is taxable. You may see something in the international press these days that talks about the OECD, the Organization for Economic Cooperation and Development, and their project on BEPS, base erosion and profit shifting. Those are all complicated words, I know, but the idea behind it is the OECD is working with a lot of countries, particularly European countries, to change some of the rules to avoid some of the abuses that have been going on. Like, for example, here, so some of this language is changing. But a watch out here, and this is one that I wanted to emphasize. A salesperson in a foreign country can create a PE, even though they don't have an office, not working out of an office or a factory, etc. If such person has and habitually exercises in the foreign country an authority to conclude contracts in the name of the U.S. company. That is standard language in virtually every treaty the U.S. has. So the key here then is that you can have a foreign employee selling on your behalf in a foreign country. But two things to watch out for. Don't have an office and don't have that salesperson, don't grant them enough authority that they can conclude contracts in the name of the U.S. company. You can have an employee that's in Canada or Mexico or other countries, and they can be conducting your sales for you. They can be selling your product, but they can't be concluding those contracts. Now, I was talking about some of the OECD activity. Some people have taken that a little bit further, and there are elaborate structures that people have put in place in order to avoid creating a PE. Those are the things that the OECD is after with regard to changes in the law, not only in the in virtually every foreign country. For the U.S., I don't think that's such a big deal because we have these treaties in place, and the U.S. is not interested in changing the language for a PE in our treaties. We're pretty happy with this kind of language. It allows us to have our people go outside the country, and as long as you don't establish a PE, you don't set up an office in the foreign jurisdiction, you can conduct your affairs, and as long as the activity is approved back in the home country, you can avoid taxation in that foreign country, provided we've got a treaty. Now, I also want to point out that you can have an independent agent selling your products. That's not an issue. I'm talking about having an employee or somebody that is dedicated to you. But if you've got an independent person that's selling your products in a foreign country, he's working on his or her own behalf. And so that's not an issue. That doesn't usually create a taxable situation for you. And really, the emphasis there that I want to point out is habitually and conclude. Those are your two magic words there. If it happens once in a while where somebody may be in a foreign country and you may conclude a contract, that by itself doesn't sink you. It's habitually. You've granted them the authority to do it. So selling to foreign customers can be structured in a manner that avoids a taxable presence. That's a pretty simple thing to do, really, from a U.S. tax perspective. And that's really the headline that I want everybody to understand and to take away from this. I don't want you to be concerned that if you're going to be selling to foreign customers, if you're going to be promoting your products in foreign countries, if you're going to be selling through an independent rep, those things don't create a problem for you in the foreign jurisdiction. Now, let's talk for a minute about operationally, because VAT, or value-added taxes, are something that we don't have in the U.S. Almost every other developed country has one. They typically range from, say, 5 to 20%. The OECD or the EU has a cap on how much it can be. I think the EU rules limit it to 21%. But they typically range from 5 to 20%. We don't have one, so sometimes when we're dealing with cross-border transactions, we can get all confused with VAT, and it generally isn't a big problem because U.S. exporters are generally not required to collect and remit VAT from customers in foreign countries. Now, there may be exceptions to that. Like, for example, I deal with an awful lot of clients that have a good deal of business in Canada. And the threshold for whether or not you would register for Canada's VAT, which Canada calls it, by the way, a GST or HST, goods and services tax, or the harmonized sales tax, but it's basically a VAT. The threshold for whether or not you would, or your business would need to register and collect it from Canadian customers is a little bit different than that PE exemption that I was talking about for income tax treaties. Because remember, this is a different type of tax. But even so, even if you cross that threshold and should be collecting it from your clients or your customers, it's not a particularly onerous issue to register and then include it on your invoices, collect it, and remit it. Although, as I said, generally speaking, you're not responsible for doing it. There may be some situations where if you have enough of a presence in a foreign jurisdiction, you're going to need to. But again, one of the things that I want to make clear here is that VAT, particularly from a U.S. exporter's perspective, it's not horribly complicated. It's a pretty simple tax, really. It builds throughout the system. Manufacturers, when they buy their products, they pay VAT, and then when they sell their products, they collect VAT, and what they are required to do throughout the process is then remit the net amount. It can be a little bit of a problem when a foreign country then if you have to pay the tax in the foreign jurisdiction and then request a refund. I know Mexico is one where the VAT refunds can get quite lengthy. Brazil was another one where companies had that. But I'm getting off on a little bit of a tangent here. The thing that I want to stress is that if you're a U.S. company exporting from the U.S., the VAT is not insurmountable, and it should not represent an incremental cost to the company, other than perhaps the incremental cost of the administration associated with it. It's a tax on the ultimate consumer. So if you're selling products to foreign customers, they should be the ones paying it. They either pay it themselves, they pay your invoice without the VAT, and they remit the tax to the government themselves, or, as I mentioned, you register for it and pay it. But VAT is not an overly burdensome tax from a U.S. exporter. So don't be intimidated by that one. So now I wanted to segue into living with a PE. And by this I mean, if you are going to have a taxable presence in the foreign jurisdiction, what does that mean for you? Well, it does mean that you're going to be paying taxes on your profits attributable to the foreign activity, but those aren't necessarily a problem either. As I mentioned earlier, the U.S. tax system allows you to claim a foreign tax credit, and that's a credit, when you pay taxes to a foreign government on income that you're recognizing here in the U.S. And it's important to point out that's a credit. I want to differentiate between a credit and a deduction. Non-tax professionals may not be familiar with the difference, but a credit is a dollar for dollar reduction in your U.S. income taxes, as opposed to a deduction. A deduction is going to reduce your taxable income, but it only saves you money at the marginal tax rate. So if you're in the 28% federal rate and you claim a $100 deduction, a deduction is only going to save you $28. But a credit of $100 saves you the full $100. Now, I do want to point out that foreign tax credits can be a very complicated area of the law. There's a lot of accounting numbers crunching that goes on with it. In the U.S., you have to demonstrate how much foreign source income you have, and you're limited to the amount of U.S. tax that you would pay on that foreign source income. So it can be complicated in terms of calculating the numbers, but from an overall tax policy perspective, the key here is that providing you're not paying a high tax rate, and generally speaking, the U.S. has higher corporate rates than virtually everybody else in the world, you should be able to use those credits. Now let's talk for a second then about how do you structure it. If you're saying, yes, we want to go to Europe and we need to set up an office, so remember that's going to create a PE for you, but how do we go about doing it? Because there are various ways you can structure it from a legal perspective. You can have a branch, which is just an unincorporated portion of the U.S. company. Or you can set up your own foreign company. That's an entity set from its owners, and it would be paying tax itself. You could set up a limited liability company. If you're familiar with LLCs here in the U.S., most countries have a foreign equivalent. The only one that really doesn't that I'm aware of, well, there are a few smaller ones, but most of the major countries that we deal with have an LLC equivalent. Sometimes they have two. But Canada is the one that doesn't. Canada does have something called an unlimited liability company, a ULC. So sometimes you may see in a company's name, ABC Company ULC. Or something to that effect. Sometimes it's NSULC. The NS stands for Nova Scotia because that was the first province that permitted ULCs in Canada. You also might structure it through some kind of partnership or joint venture, and that can be somewhat complicated. And really, a joint venture can take any number of different forms, so it's difficult for me to talk about them without some very specifics. The other thing I wanted to point out here is that the U.S., with regard to LLC type of entities, has very, very favorable regulations because it permits companies to adopt the tax treatment of a foreign entity for U.S. tax purposes. So you can get the best of both worlds. I'm going to show you some examples. But you can elect to have a foreign entity treated if it's disregarded or is completely disregarded. So in effect, from a U.S. perspective, it would be treated as a branch. Then that's if it has one owner. If it has more than one owner, then it would be treated as a partnership, or it could be treated as a corporation. And I just can't stress enough how beneficial these are for U.S. multinationals. It's very, very beneficial rules. So let me show you how this would work here. Unincorporated operations. If a U.S. individual and a U.S. corporation establish foreign activity, they'd have a foreign branch. Both the U.S. individual and the U.S. corporation are taxable on their worldwide income. So the foreign branch profit is taxable in the U.S. The foreign branch is likely to have to pay some tax in the foreign country. So both the U.S. individual and U.S. corporation are able to claim foreign tax credits to offset the tax in the U.S. on that foreign branch profit. Now, how you determine how much profit is attributable to the foreign branch is something that we'll talk about a little bit later. That's done with transfer pricing. I'll touch base on that. Now, partnerships are pretty similar if you work through a foreign partnership. So I'm going to go through this one very quickly. Again, a foreign partnerships may or may not pay tax in a foreign jurisdiction. Sometimes they do. So either the foreign partnership would be paying tax in the foreign country, or the individual or U.S. corporation would have to file a return on their rateable share. But in either case here, both U.S. individual and U.S. corporation would recognize their rateable share of the profit from that foreign activity, and again, be able to claim a foreign tax credit. Now, this one is where it differs a little bit, and this is one of the things I want to point out. If a U.S. individual owns a foreign corporation, and that foreign corporation is taxable and it's outside the U.S., the U.S. individual is not taxable on the foreign corporation's profits. Foreign corporation is a separate entity, and under our principles right now, we don't pay tax on undistributed earnings of a foreign corporation. Now, those profits would be taxable when they're distributed back to the U.S. This whole concept is referred to as deferral, and you may hear about it in the media. That concept is a political football, and it's how major companies like Eli Lilly here in our own backyard here, and it's why they keep so much in the way of earnings offshore. Because when they bring those profits back, they're going to be taxable. But as long as they keep them offshore, they don't need to pay the U.S. tax on it. Now, the U.S. individual, if he gets a dividend and receives a dividend from a foreign corporation, there may be dividend withholding taxes on it. The dividend withholding taxes are creditable, but the taxes that foreign corporation paid are generally not creditable to the U.S. individual. So there would be double taxation in that structure. Now, this is different from a U.S. corporation. Where a U.S. corporation, and when I say a U.S. corporation, I'm talking about what you may hear of as a C corporation. We also have an S corporation, which is a flow-through type of an entity. And this applies to U.S. C corporations. If a U.S. C corporation owns a foreign corporation, the foreign corporation, again, has its own profits. U.S. doesn't recognize those profits until they're distributed in the form of a dividend. When they're distributed, in order to avoid double taxation in the U.S., U.S. corporation is permitted to claim a foreign tax credit for those earnings. Okay? So that's how you avoid double taxation on corporate earnings. So that's a big differentiator between U.S. treatment of an individual and U.S. corporate treatment. Now, you might think, well, that's not really fair, is it? Well, yes, actually it is. Because if you were to replace, in my diagram there, foreign corporation with a U.S. corporation, if a U.S. individual owns a U.S. C corporation, there's double tax involved there too. So the idea behind this tax policy is to put foreign earnings on a par with U.S. earnings with regard to how they're treated in the U.S. tax system. Okay? So I want to point that out. Make sure everybody's okay with it. Now, I also want to just touch base here on these hybrid entities. Remember I said we have these very, very favorable rules. Frequently you may hear of them referred to as check the box rules, because literally you can file a form with the government and elect how you want your foreign subsidiary to be treated. So this diagram is virtually the same as the prior one, with the exception that now these are foreign LLCs, and we made a check the box election to make them disregarded. We made an entity classification election. That's the official name for it, but we all call them check the box elections. And so we are treating this type of an entity for U.S. purposes as a branch. Remember, we talked about how a branch is treated. So the U.S. individual in this case would recognize all of the income, but they'd get the foreign tax credit. So you avoid double taxation. You give up deferral, but you avoid double taxation. So this is a kind of structure, or this type of planning is very common for people who use flow-through entities, partnerships, S-corps, or if they own the business directly. The prior slide, and I'm going to go back to it here, this on the right is how you see most corporations structure, because they can take advantage of deferral. Okay? So those are some of the basic issues that you deal with regard to structuring foreign operations. You'd want to figure out if you want to take advantage of deferral or flow through, and that depends upon your overall tax situation. But the key that I want to make clear here is that you can do it in a manner that doesn't really increase your overall tax obligation. And that's because of the foreign tax credit. As a matter of fact, let me go back here for just a second. If you were to go back to this situation, if you were a U.S. individual who owned a foreign corporation, and if that foreign corporation was in a low tax jurisdiction, Ireland is a common low tax jurisdiction. Their tax rate is 12.5%. So if the Irish profits would be taxed at 12.5%, and then you distribute those earnings back as a dividend. Under our current rules, that would be a qualifying dividend, and it would be taxed at the capital gain rate. So that combined tax rate is considerably lower than if you were to do it with this kind of a structure, because the maximum rate here for that individual would be 39.6%. So they'd still pay 26% or so on their in the U.S. after paying the 12.5% foreign or Irish tax. So again, it matters where you're going to be putting your business, what the tax treatment is going to be, whether or not you're going to have a PE, etc. But if you're going to have a PE, you need to spend some time trying to figure out what the appropriate structure is for your organization. My advice would be to avoid a PE at first, because that's going to give you the easiest answer right there. I got a question that came in here. Let me see. As a small business owner, can my general business accountant handle my international business tax needs, or do I need to find a tax specialist? Ugh. That really depends upon how complicated the issue is. Now, I will tell you that we work with some clients where we are just their international advisor. You know, we obviously, as a CPA firm, we'd like to have the overall relationship. But I also know that we're a substantial firm. You know, we've 550 million revenue. We've got 35 offices across the country. So we're likely to be a more expensive alternative than a sole proprietor. So what some people do is just use us on very specific international questions. So Cassandra, I hope I've answered your question there. Let's go to the next topic here, transfer pricing. Now, transfer pricing is an issue you're going to hear anytime you start talking about cross-border activities. Anytime you deal with a transaction that crosses the border, you're going to have at least two jurisdictions, maybe more, concerned about the price at which products transfer, or services. The same concept applies to services as well. Section 482 of the U.S. Internal Revenue Code provides the authority for the IRS to adjust the price between those two related parties. All governments have similar rules as well. As a matter of fact, many states, because sometimes you can take advantage of transfer pricing here from a state tax perspective as well. So frequently, domestically, many individual states have adopted their version of 482 as well. But the key concept to be aware of here is that the U.S. corporation is going to sell to foreign corporation, and foreign corporation is going to sell to the foreign customer. At what price does foreign corporation purchase the product or services from U.S. corporation? If we're going to talk about Ireland again here, you would be motivated to make that a very low purchase price, and capture as much profit as you can in foreign corporation right there. Of course, the U.S. is to that, as every country is, because transfer pricing is the 800-pound gorilla in the international tax world. And so you would need to be able to justify and document what your transfer price is and why. There's a whole part of our international tax group that provides those kinds of services. And there can be significant penalties if you're not transfer or pricing your product to a related party at what is deemed to be the arm's length price. And bear in mind too that is a range of pricing. It's not as if it can necessarily one particular price, and there's a variety of means to determine what that arm's length price is. But if you're doing a lot of business across the border with a related party, I want to emphasize that, then this could be a significant issue, and you should probably have some conversations with somebody who's knowledgeable about it. Now, if it's not a huge number, people or the foreign governments, in my experience, have not paid a lot of attention, or neither has the U.S., when the numbers are not all that material. But where they are material, the U.S. focuses a lot on this, and this is the basis for a lot of disputes between the U.S. and taxpayers and foreign governments and U.S. taxpayers. And the other point I wanted to make here too is we talked earlier about a foreign branch. Well, a branch is just a part of the U.S. entity, and so transfer pricing and typically our treaties provide that you would treat it as a separate unit. So you would still need to deal with transfer pricing rules, particularly from the foreign perspective, to determine how much profit is attributable to that foreign entity. Okay? One thing, I get a lot of questions on this, so I wanted to talk about here what I call bogus tax planning. Remember I talked before about foreign tax credits being available, or foreign tax rates, I guess I should say, being low in a foreign corporation, and you wanting to put as much profit down there as you can. Well, the U.S. has been onto that scheme for over 50 years. Back in the Kennedy administration, they adopted something called Subpart F Income. So in a situation where you sell to your foreign corporation, and your foreign corporation is located in, say, the Cayman Islands, someplace where you really don't have customers, and that company then sells outside of the Cayman Islands, you don't get the benefit of deferral on this one. I have to explain this to so many people because they hear in the media that this is how big companies avoid taxation back in the U.S., and yes, there is true, there is some complicated planning that can go on where they keep the earnings offshore. But for most companies that are looking at starting exporting activity, this is not good planning. You're going to get burned here. As a matter of fact, it's under Subpart F, the profits in that foreign corporation are deemed distributed. And further, not only are they deemed distributed, so you lose your deferral privilege, you have to pay tax at the ordinary tax rate. So if an individual owns that company rather than U.S. corporation, you lose that benefit of the capital gain tax rate. So it can really be terrible planning. So don't do that one. Or before you go into this kind of planning, have a conversation with somebody that's knowledgeable in the area. Okay? Now I'd like to take a few more minutes. We've got a few minutes left, about 5 minutes here. I'd like that's what I was planning on. And I just want to talk about this incentive that's available. If you are producing goods in the U.S. or if you're buying goods that are produced in the U.S. and selling them outside the U.S., there is a significant tax incentive that's available. And it's really only available to privately held companies. It's a disc or an IC disc. You may hear it called an IC disc. I typically use the old term disc. Discs have been around since the early 70s, but they kind of fell out of favor and were replaced by other export incentives. But ever since 2004, when the capital gain rate came into being, the DISC provided a really substantial tax benefit. So if you are a small business, you're selling what's known as export property, and we'll talk about that real quick, outside the U.S., you should really consider establishing a DISC. Let me show you how it works. If you've got a flow-through type of an entity, you can establish a separate company, the DISC or IC DISC. If you've got a flow-through entity, put it underneath, put the DISC underneath. The S corporation or the partnership can pay a commission to the DISC. And I'll show you how much that is, but let's just say for right now, it's half of the profit on your export activity. The DISC can then pay a dividend back to the company. So the money really never leaves the business. It just kind of comes in and goes out of the DISC. But you get to capture tax rate arbitrage. You get the deduction against ordinary income, which at the maximum rate is 39.6%. And the dividend comes back to you at 20%. There's also the 3.8% net investment income tax. You know, if you read the headlines, that may be repealed. But the capital gain rate, then, even if you're going to take the 23.8% rate into account, you still get a 15.8% permanent tax benefit on profits attributable to those exports. It's free money, and for anybody that's doing it, they should be taking advantage of it. Privately held C corporations can also benefit, but the structure needs to be a little bit different because C corporations are taxable on a DISC dividend. So you need to make the DISC a brother sister. But I do this with many companies that are C corporations, and the benefit is effectively that the C corporation, remember I explained before that a C corporation earnings are really subject to double taxation, once at the C corp level and then once when the earnings are distributed to the shareholders. But what the DISC allows you to do is just incur a single level of tax on those earnings, because the C corporation gets a deduction for that commission that goes to the DISC, and then the DISC can distribute it. The DISC is a tax-exempt entity by statute, provided it meets all the rules and doesn't pay any, or doesn't violate any of those. It doesn't pay any tax. Very, very powerful structure, and is one that is often overlooked. Let me just tell you that what qualifies for DISC benefits is the sale or lease of export property. To be export property, it needs to have three characteristics. It needs to be produced, the actual language is manufactured, produced, grown, or extracted in the U.S. by a person other than a DISC. A DISC is just a sales company, so somebody else has to do it. It has to be held primarily for sale, lease, or rental, or consumption outside the U.S. And then there's a foreign content rule. It has to be, or it can't contain more than 50% foreign content. Typically, that's not a problem. I've only run across that being a problem in some fairly high-end electronics and some precious metals. Other than that, because of the way the foreign content rules work, if it's produced in the United States and you meet that definition, typically the cost of producing it, along with the overhead allocated to it, along with your profit, usually gets you well into the 50% category. There's also a few other limited receipts that qualify, like, for example, engineering and architectural services. So engineering and architectural firms, frequently you'll see a DISC in their structure because their international activity can qualify. So calculating the commission can actually be quite complicated, but the basic rules, there's two basic rules. You can take half of the profit on the sale of export property, or if your profit is low, 4% of the qualified export receipts. But you apply those rules and some of the other ops on a transaction by transaction basis. So you might look at your export activity and say, well, I have 10 million of export, and on that I've got 1 million of profits. Well, that would be 10%. And you could then say, well, okay, I could put 500,000 in the disc. That would be terrific. But when you look at things on a transaction by transaction basis, some transactions might qualify for the 4%, some might be for the. You can do it on a detailed basis. And I've got clients where they wipe out almost all of their export profit. Certainly 75%, and some as much as 95% of the export profit by doing the calculation and taking advantage of all the detail rules. So it can be very, very profitable. In addition, you can take advantage of something called deferral benefits. You can put the commission in the disc, and then instead of paying that capital gain tax on the dividend back, in some situations you can do a loan or acquire other assets, what's known as qualifying export assets, QEA, and keep the earnings in the disc. And so you'd be deferring those profits. Now, if you defer profits in the disc for more than a year, there is the interest charge on it. That's why it's called an IC disc. But it's a very, very low rate. It's tied to Treasury bills. It did spike up a little bit this year. It's up to 0.54%, but that's still a very, very low rate. Last year it was, I think, 0.16%. The year before that, I think it was 0.24. So, we've had very, very low interest rates, and so this interest rate charge here has been very, very beneficial to an awful lot of companies. I've got a lot of clients that take advantage of this. Okay, let me see. We do have one question in here. What about services provided to foreign clients via the internet? That's a great question, because the internet has really changed everything. Via the internet, small companies can look like huge companies. Small companies are able to conduct business internationally. There used to be a lot of controversy and a certain amount of angst, I would say, about business through the internet and how it got taxed, but we've had it long enough now that things have settled down. I mentioned earlier the OECD's BEPS project because there was a lot of abuse in the area. And generally speaking, if you're a U.S. company where you've got your bricks and mortar and employees here in the U.S. and you're going to be selling to foreign companies via the internet, you really will not be taxable in most foreign jurisdictions. Now, if you're providing services, your question deals with services, sometimes foreign countries will impose a tax on the importation of services. So if you're here and you're providing services to somebody in Brazil, Brazil's one country that does this. In Brazil, you're going to charge them $100. They would only wind up paying you $85, and there'd be $15 withholding tax on that importation of services. Puerto Rico, I think, is another one that has a tax on services. But there's people seem to think that it works the same way, but it doesn't. I think people need to read the law. So generally speaking, when you're providing services, services under the U.S. rules are deemed to be provided or deemed to be sourced where they're provided. So if you're here and you're providing them, those are domestic. Now, if you're talking about a payment for the use of intellectual property or royalty, if it's really more of a disguised royalty, that would be treated more as foreign source income from a U.S. perspective, and that may be subject to a withholding tax. And again, the treaties can reduce, that's something where treaties can be beneficial on, is they typically reduce withholding. Like, for example, the U.S. imposes 30% withholding on a royalty paid by a U.S. person to a foreign person. But if that person is a resident of a treaty country, that royalty can drop down to 15, 10, 5. In some cases, it's 0. Just depends what the exact treaty is. So hopefully I have answered that question. If not, let me provide everybody my email address. My email is tjmiller@bkd.com. I'd be happy to respond to questions. I give a number of presentations, either via webinar or I speak at conferences pretty regularly, so I get a steady stream of questions from people. And if it's just general questions, I'm happy to respond to that. Or if you need more elaborate advice, I'm happy to provide that as well. But to give you advice that you could rely on, we'd need to have an engagement. You'd need to engage me. Okay. Any other questions? Well, thank you, everyone.
It looks like we're good. Thank you so much, Tom. This has been very helpful, not only to our audience, I'm sure, but I learned a fair amount as well. So we appreciate your time and expertise, and thank you to our audience. Hopefully you found this webinar helpful for your business, and you'll let us know your feedback. This webinar will be archived on our export resource page at indychamber.com/globalindy for viewing and sharing. And for those of you who are on this webinar that are interested in getting connected to more export resources, we want to let you know about our partners at the Central Indiana Small Business Development Center. We'll be hosting a live Export 101 event in partnership with the Greenwood Chamber of Commerce on January 25th from 3 to 5 p.m. at the Greenwood Chamber of Commerce. There's information on their website, or we will be sending all of you a link to the information on the seminar as a follow-up. Thank you once again. We hope you'll join us for our next export seminar, and we hope you all have a great day.